She says I'm ready. She says I'm ready. No, she says I'm ready. I can microphone. Hey, ladies, how you doing today? I'll speak at once with your mouth full.
I am not a year older.
You're not? I am. I feel like more than 5 years older. Every year's a dog year. I'm accelerating at quite a rate. Is it running, huh? Oh, it's every 20 minutes it has to... I won't pay any attention to that. Man, 3 complete rows of emptiness. It's weird.
We're still missing about 20 people, so...
Oh, really?
Yeah, they'll fill in.
They'll fill in over time?
That's
How y'all doing?
coming in late. We're doing good.
Are you? Business is good?
Yeah.
Everybody's happy, healthy, wealthy, whatever, and ready for 400 minutes of fun. Wait till tomorrow. It'll be 200 minutes of fun, but it's Friday, right? Anyway, it's good to see y'all again. I'm happy to be back here. I hate the fact that every time I visit here, it marks a year. Just like you were saying. I'm not a year older. I'm like 5 years older. So it's kind of strange because I have one more trip next week, and I have been on the road now for almost 5.5 months. Doing public housing, some other stuff, consulting with HUD. And then I started training earlier I started actually training in July. So anyway, it's always good to mark the time in Atlanta because I get out of the bad weather. Last week we were in Minneapolis, and this week it snowed 18 inches, so it's good planning. And you guys aren't going to get snow or rain until what? Friday, Saturday or Sunday. Well, rain, I guess. I don't know. It's supposed to get into the 40s and rain. No snow, huh? Snowing at home today. So where my daughter goes to school, which is only 60 minutes from my house, it was 2 degrees yesterday and snowed a foot this morning. So we're anxious to go home. In Utah, just north of Salt Lake. So she's a little farther north from my house, and it was the further north you went, more into Idaho, it was close to a lot of snow. Okay, we're here today to talk about our HUD update. What time's lunch, by the way? Noon? Let's plan this all out, right? I don't know what the story is. If it's warm food, we'll stop whenever it's ready. Sandwiches, okay. Sorry, lunch is at noon. Break at 10:15 or so.
We are going to have to shut the door out there, so there is a key card if anybody needs to go to the restrooms.
Teacher, may I? Nope, the card's already gone. Go together and hold hands. The HUD update this year. By the way, 2:15 break. We'll be out here by 3:45. You all have an event tonight, right? So my mandate was to have you out here by 4, but we were going to be out of here by 4 anyway. So be about 3:45, and then we can reconvene tomorrow for more fun and games for a half a day. So our agenda today it's kind of the good news, bad news thing, as Jana knows. The good news is there's no changes to the HUD audit guide, especially the report side, which was really miserable in the last 2 years to have all these changes. The bad news is there's no changes to the HUD audit guide. And George Datto retired and is gone, and his boss, quasi-boss, I don't know, is Jim Heist, and he's already been retired, but he's still working as a contract employee. Other than that, we've found out that nobody has any interest in HUD OIG. Nobody has any interest in the HUD audit guide. So it's kind of a tragic place to find ourselves in. Jim Heist told Peter just in the last week or two that he's trying to give the audit guide to REAC, which basically have no CPAs except for Wendell Connor and his team. So it's kind of a precarious position for us. because the audit guide right now is just wrong in so many ways. I mean, it's just not the document that it should be. And in fact, by the time you finish today, you'll have 4 or 5 places you have to make a change, or you will just be wrong. So we're going to go through those today. The morning session is a little more general. Jenna, you made it to Vegas last year, didn't you? So what did you think of Jim Pollock last year, the guy from DEC? That was pretty interesting. I sometimes don't listen too much to the HUD guys, depending on who they are, because I kind of know their spiel. OIG, I'm already used to what they're doing. I've seen their work in the guide and their explanations of it. We're glad to have them, but Pollock was a little different. And he made a comment. His overall theme, or the thrust of his presentation, was simply this: we exist at DEC for one reason, and that reason is to enforce the business agreements. And in fact, they are really the enforcement arm of HUD. REACT, doesn't do enforcement. They do assessment. So their only goal is to process data and then highlight the issues that the system found and ship it off to somebody else, be that the field office or DEC. And of course, when they go to DEC, the numbers are significant. That's a $10,000 event. So that's their level of significance, is $10,000 are significant. That's their level of significance, is $10,000 are significant thing within their business agreements. And he also said a very interesting thing. We don't feel constrained by the audit guide. We're constrained by the agreements. And his suggestion was clearly that if the audit guide is not in alignment with the agreements, then it's the agreements that matter. Well, that got me thinking. I listened to it for a while and I thought that's kind of interesting. But it became more of an issue this year because of course, last year we had a new regulatory agreement. And this year we have another new regulatory agreement. So one of the things we really wanted to do is readdress from a foundational level Chapter 3. But to do that, we're going to start and spend the whole morning looking at some sort of other issues related to how we would interpret Chapter 3 in this environment, because HUD is doing a lot to reorganize. They are in complete disarray at the field offices, as you guys well know. Of course, maybe you don't. You do so much with Atlanta. They're, but already consolidated up, right? Others haven't. I spoke 3 weeks ago on Thursday, just with the head of the Hartford field office. They had invited her, the firm had invited her into this discussion, and the firm had invited her into. They had invited her this discussion, and the firm they had invited her into. The firm's discussion, and had invited her into But it's pathetic, okay? And everybody knows it, and the government is failing. And of course, we have tried to get public housing to manage differently. In fact, I personally have been on 3 or 4 contracts where we would visit these places and go there and do this, and it's like, please listen to us. And we tried to have them evolve into a process where they were real businesses. And we started this in '98 when we came to REACT. We said, everybody files now, right? Everybody gets a central look and assessment at your financial status and how well you manage the projects. And of course, REACT was inspecting them also. Well, within 3 or 4 years of that, we put them into GASB 34. And we said, by the way, HUD goes, you're a business enterprise. So we treat you as enterprise funds. HUD dictated to say, you're not a governmental fund, you're an enterprise fund. Because you need to manage your projects like you were trying to make money. So in my town, the city owns the local utility, right? They own the power grid in our neighborhood. They run that like a business, so that's an enterprise fund. We did the same for housing authorities. Within a short time after that, we began, and all this is designed to try to rid the world of waste. Because housing authorities end up managing essential. Let me ask you this. When you go to the DMV, are they there to serve you, or are you there to serve them? You have to do exactly the issues the way they want it done, particularly, or they shove you out to the back of the line and yell at you and treat you like crap. There's the other word I'm not supposed to say. So, you know, that's how public housing got. It existed for its own employees. It was an organism that really wasn't servicing clients or tenants. It was servicing employees. And so benefits are out the window, are clear, astronomical. Some places we take to get a fully loaded thing, we'll take 1.6 the wages. Well, that would blow everybody away. And sometimes unions are big into there with the governmental side. So anyway, we were trying to manage them to focus on the project, right? Get them to think about the project the way we do in multifamily. Anyway, we put them into asset management, and we went through that revolution, all with the goal of trying to manage. I mean, when I show up, literally, I tell them, if your housing authority survives this day, it's a miracle, and I don't care. If it doesn't survive, I don't care. I'm not here to help your housing authority survive. I'm here to stress and work on maximizing the viability of the projects. So what matters to us is the viability of the housing project, not the housing authority itself as an organization. Well, here's the end of the train. We're on a line of continuum. We've started to weed out the winners and the losers. Now here's where we go next. And here's now all this little story is to get you to understand something very important. HUD now realizes, then Congress realizes, they can never fund a lot of these housing authorities into happiness. They don't all have the management to make themselves better. Atlanta, okay, has a housing authority, was one of the first to become what we call a moving to work agency. And they had a lot more flexibility in their funding. And they've basically retooled their whole housing stock. So they're really a great operator now, and they don't have a lot of problems. They've entered the capital markets, tax credits, started building a lot of new homes, transitioned out of a bunch of old stuff, tore it down, whatever. But not everywhere is Atlanta. There are only 15 cities across the country that went moving to work, or housing authorities. So a lot of housing authorities don't really have that background to do this, and HUD's going, look, we have no money to replenish the stock because the bones are old. You can't maintain some of these buildings enough. So what they decided to do is they came out with the next great land grab of the 21st century. And that is going to be the conversion of public housing into multifamily housing. We're into the first 60,000 units of a process called RAD, Rental Assistance Demonstration Program. This program allows the housing authority to convert its public housing units into new housing. And it will guarantee, they will take them out of the public housing program and then give them a 20-year HAP contract or a 20-year project-based voucher contract with a mandatory 20-year renewal. So they're basically giving them 40-year assistance contracts and telling them to develop them in whatever way they want. They can tear down, they can rehab, they can do any process that suits them. But they have to find partners to do the work. Housing authorities, if they could have done all this themselves, they would have already done it. So what they're looking for in the market now are partners who do multifamily development that can come in, help them arrange the financing, tax credits, whatever this is, construction, and at least 50 to 55% of these entities will come out of these deals with 40-year HAP contracts. Now, Jana knows if we were to tell the world right now we had a lot of development going on with 40-year HAP contracts, there would be a grab for those fast, wouldn't there? So the problem right now is just this. Congress has been so inward-looking on whatever their issues are, like I haven't been reelected, and all the other Ebola or whatever, right? I don't know. They haven't approved the next group of units. They're just stuck. It's a great deal. In fact, it has to happen. Now, some people are afraid that we'll get rid of low-income housing as a result of this, but every one of these units gets a use agreement tying it to low-income housing and the mandatory 40-year contracts. Yes, ma'am. Oh, really? Yes, ma'am. Yes. How did you have a property that did that? So they got a. Are they? So you got a new project that's really been developed. Uh-huh. Okay, well, they get a HAP contract that does require multifamily reporting. It will be over $500,000. So it hadn't seen her for a long time. Why? So they have exactly the same multifamily reporting requirements that your other multifamily clients have. Now, if they went to a project-based voucher contract, that may be different. Okay, now, typically, the housing authority's ownership or connection to these projects varies. In some cases, I've seen San Francisco. When I talked to them in Seattle, I taught a class for HUD in San Francisco just in July, I guess. And it's been a long time. They came to the class and they said, Les, we're happy to see you again, because I'd been consulting there before, trying to help them pass this process called stop loss. And anyway, what happened out of all that was they had a real problem in San Francisco because they couldn't reach any sort of financial viability, because in some units, 80% of the tenants don't pay their rent, the tenant portion of rent, because they found out the city would never allow the housing authority to evict anybody, because the biggest concern in San Francisco is homelessness. I mean, there's tons of homeless around there, pushing those shopping carts around. And the mayor says, if you evict people out of public housing, they will become homeless. Well, first of all, the idiot doesn't really understand homelessness, because the people you see on the streets, they'll always be homeless, because they can't live in any rules or structure, and they can't even fit in a shelter. So most of these other people are going to not be homeless. They're going to actually find out they have to pay the darn rent. Okay? Anyway, they had a plumbers union that was strangling them because of their refusal to negotiate. Oh, my heck, he's in the suit again.
He had a board meeting.
And he's got the Lucky Kelly green tie and... Dude, just get the message and move. Don't bump the camera. Oh, dude. Welcome aboard. This is a tough crowd. Okay, so they had the plumbers union they couldn't negotiate with. So finally San Francisco washed their hands of the whole damn thing with RAD, and they said, here's what we'll do. Developers, come in. They brought some private developers in, multifamily developers, and they said, here's what we want to do. We want to tear these things down and let you build new ones. You get to own the whole building, developer. Here's what we're going to do. We're going to keep the 99. We're going to give you a 99-year ground lease. You own the building. We don't want anything to do with this building. We have no ownership in the building. We're going to convert these buildings into 40-year project-based vouchers, and the only thing we get out of this is the admin fee for administering the voucher program. You own, manage all the units. All we want is the voucher admin fee. So that's how far it went. They just washed their hands of every building they owned in those 4,500 units to be rid of it and be done, because the mayor can't hold sway over the private developers the same way he can on them. So that's a full boat dump of this process. So, well, what happens now, the 60,000 is the first. Then there's another tranche planned for 180, and those have been now pretty much committed because people are sending in applications waiting to get approval. But what we're going to really end up with are millions of units at some point. This will stop being a demo program and go to a full program. Now, the concerns from the parties are this. Number one, will we really get rid of public housing? Are we hurting the people by letting the robber baron land grabbers come in and develop projects? Well, I don't know. Are they bad when they have Section 8 housing? Or is that fulfilling a role? Is Section 8 housing successful? I would make the argument that I think Section 8 housing is very successful, has a low-income tool. Probably more so than public housing because the developers are on the hook for the buildings and have to always continually regenerate the stock or nobody lives there. So if your building gets old, you tear that one down, you move the HAP contract to the next building. And you're forced to continually live in that model. It's pretty hard to be a slumlord in the Section 8 program. Rita.
With a lot of our clients that they do a lot of these joint venture things. So a lot of our developers have some units set aside that are public housing units. So
Well, they'll be vouchers, won't they? Are they actually doing public housing units?
they actually have public housing units set aside, and they pay for all the expenses related to those units. So out of 100 units, there may be 60 set aside for public housing or 40.
And they'll put a public housing unit in there.
Yep.
So this is the next evolution of those partnerships. I'm sure they know what's going on. So trying to inform you guys about it for other clients. This is the next big thing in housing because we're going to convert over the next 10 years. You think about coming back into the market and telling developers now you have 2 or 3, 4 million units of Section 8 housing with guaranteed 40-year contracts. Do you think they're going to build those buildings? The money will flow to that need because they either need to rehab what they have or they need to tear down what they have and start over. And the ideas behind the change, and maybe we can spend a little more time on it tomorrow, actually talking about the program just for 30, 40 minutes, because I have some slides on it. Their goal is to make it subsidy neutral to the government, so budget neutral to the government, so whatever they give in capital fund and low rent housing or public housing subsidy will just be exactly the same subsidy they give in Section 8. And the goal was to give the subsidy to the people and have a rehabbed unit, completely redone housing stock, because right now it's not good. It's not good at all. So the HAP contract, I have a copy of the HAP contract. Maybe tomorrow we'll take a look at the actual HAP contract you should be getting. I'm assuming it's project-based. They call it PBRA, project-based rental assistance. But in our words, it's the same thing as it's a Section 8 HAP contract. So I'll go through the contract tomorrow morning, okay? And you can see what the requirements are going to be. What we have told them, though, is if you go PBRA into HAP, our HAP contract, they will be filing in the REACT system with audited statements and audits in accordance with the HUD Audit Guide. It'll say they have to file under 24 CFR subpart or Part 5 subpart H. It'll give them Uniform Financial Reporting Standards references. Okay? But that's what HUD, because I've actually, I know I've worked on a reporting notice for them, and I don't know if it's actually been released. I can share that with you tomorrow, but it's clear where we're going. Public housing people are telling them you may have an audit. Even if you keep some ownership interest that actually gets reported under the PHA, you'd have a separate, you have filing requirements because you have, all these entities are single asset entities with their own unique tax ID numbers. So they'll be audited with multifamily audits.
So are these public housing authorities freaking out because now their jobs are being done?
Well, I think some people are, obviously, because they don't need the same amounts of folks. But the goal is to what? Well, the goal is to house the people better. Frankly, if they hadn't been such idiots, let me tell you how bad it gets. South Carolina, I was on a consulting job. We pull up at the housing authority. We're there a little early. The palm trees are blowing in the breeze. It's winter, so I'm happy to be down there. And I'm sitting in the back seat of the car with the other two guys, and we're trying to get motivated to go to work, right? And I'm looking out the back window, and I'm going, what the heck is that? I'm looking through the fence where they have all their company vehicles parked. It's a big chain link fence. And there are a bunch of white cars sitting there, Chevrolet Cavaliers. Real POS cars, right? But they're new. They're new POS cars. So I said, how many of them are there? So I get out of the car and I walk till I can get a view on the bumpers. Hell, there's 18 cars in this parking lot. They have 600 units of public housing and maybe 400 or 500 units of voucher. Okay? So I'm going, what the? We already know this is a boondoggle beyond belief because it's what we see every day. We're just so immune to it anymore. We don't even get angry anymore. We just sit and laugh at the stupidity of it. So I asked him later, I saw those cars out there. What happened? Well, we had a little extra capital fund money last year, $240,000 that we didn't quite know what to do with. So we went out and got a deal on these Chevy Cavaliers and bought them. Why? Well, our employees could drive them to the site so they don't have to drive their own cars and have the risk of getting vandalism. Tick, tick, tick. All this because some contractor won't come in and live up to their word, right? Yeah. Hate those guys. And they said, we're worried about driving our own cars out to the sites. I said, well, you only have like 25 employees. It's what, a car and a half? An employee and a half per car? And so I'm looking at this going, this is the biggest, you idiots. I want to take a torch and burn the whole place down. Napalm could not get rid of this building fast enough for me. And they're sitting here like they are the most righteous, cared about the tenants. I said, well, maybe you wouldn't have all that vandalism worry if the tenants you took that $240,000 and built a new basketball court down by the units. Well, then it's just a problem for the gangsters to hang out. Well, drive your cars, right? So they became so housing authority centric, they didn't care about the projects. And that's why we're really going through this. You don't see that kind of waste in the multifamily business. It's just not geared to that. I mean, HUD worries that it's there, but it's nowhere like public housing. It's just not governmental. So everybody, the rich, maybe some rich robber baron at the top making money. But the units are the ones making the money because they have to generate revenue with the units and spend the money wisely. And they just don't. So this is the next big play. I've already spent a little too long talking about this. But moving public housing into housing is where we're going next. Now inside housing, we've had major changes in and of itself. The single biggest thing you'll see out there is health care. you don't think of HUD typically as involving healthcare. And indeed, they only have probably 150 or 60 hospitals they fund across the country. But what's changed now is every 232 developed in HUD has been taken out of multifamily housing and stuck in healthcare programs. So down in this other corner, we see residential care 232. That world now is what that office is called ORCF, the Office of Residential Care Facilities. All 232 mortgages are managed out of that office now. And in fact, they've issued a brand new handbook. They've reissued every form. If you have a cost certification, their 92330 is a 92330 ORCF. And they have their own rules. They don't even follow Chapter 13 of the MAP Guide. So I'm going to talk about that just a little more tomorrow, just briefly, about how those programs have evolved. But they are managing them completely separate from HUD multifamily. So FHA still insures the mortgage, but from a management end, they are completely different than our regular multifamily loans over under the multifamily column. So it is an ongoing issue for HUD, but like I said, they have, I think, released 140 forms and documents under their own office name, and everything's been retooled for a lean process. So they don't follow the MAP guide for multifamily accelerated processing. They follow lean, and that's a completely different loan generation process. And they've really partnered now with about 50 lenders, and they're actually making the lenders partially responsible for determining compliance with regulatory agreements. Okay, so REACT still gets the submission for the realty entity, but all the operator entities are being managed through data submitted to the lenders. And they've just started this whole new process coming up this December to have them do that. Okay, it's going to be a complete rewrite of the operator reporting model. So the audited entity, the real estate entity, we call them the borrower now. That borrower hasn't really changed. They still get audited under the regulatory agreement the same way we always have. But there's an undercurrent of other changes for the operator side that are very severe. And they're struggling to make them happy with that. And so they've retooled their own regulatory agreements now. And everything's different. Now, in the multifamily world, where we'll spend most of our, clearly the rest of our day, of course, Section 8, we still deal with that. We are going to continue to have grants, 202 and 811s. I said last year they're gone. Well, Congress repented at the behest of the senior housing lobby and came back and made sure that they approved $168 million in the budget, and they'll probably do 10 to 15 projects a year. So we will have some, but I said 10, like I said, 10 to 15 per year. I guess every cycle, the congressman with the biggest risk of not being elected, he will get a 202 in his neighborhood somewhere. So from our perspective, multifamily is kind of continuing on. The insured mortgages, everything now has been retooled in multifamily to eventually end up in one regulatory agreement. Our 221s, our 236s, we're done with those. What are we trying to do with all those? Decouple those and move them back to a 223F mortgage. Of course, these are managed separately now. Our direct loan section 202s, what are we trying to do with those? Refinance those back into a 223F. Every mortgage that HUD generates or insures from now on will be one regulatory agreement. There will only be one. One ring to rule them all. Okay? So that's how HUD is reorganizing this to make it easier, more efficient from a management perspective, but also more enforceable through a very augmented regulatory agreement. So even from the one we did last year, this one's up another 5 or 6 pages beyond that one. So our contracts, of course, now here's the thing about Section 8. There are probably 5 or 6 versions of contracts minimum out there. And of course, it's very important to read these contracts to understand what rights HUD has. Now, the sad news of this whole thing is, and the field office will admit this, they know that virtually the only people that read these agreements are you. That's just the way this is. And they all confess. There isn't an attorney who reads them. Most HUD employees never read them. They think they understand what they mean because of the culture. DEC reads them when they have troubles. Okay, so DEC knows what they mean. But in our side of the industry, the only people that actually read and interpret the agreements are you. You guys. It's the CPAs that do the audits. And it's kind of the smiled at little secret that goes on in all of this, that your primary function in this is to interpret those agreements to determine compliance. Now, here's the thing about that. We have traditionally relied on the audit guide to tell us how to do that. It's no longer sufficient to make that happen. Okay? It just doesn't work. And I don't know that, maybe with these new agreements we can write something that's a little more clear. Our goal this year is when I finish next week, I have a document that I will probably suggest or send to Jim Heist suggesting certain changes to the audit guide that will match the things we're talking about today. Okay, so if you guys have comments, this is the time. For all of that. But the key is what? We'll have these old capital advances. They'll stay where they are. We get a few new ones every year. Our Section 8 contracts, our PRACs, they're all kind of the same old thing. They are, but they're different. There's plenty of opportunities to have differences in those agreements. And the insured loans, we'll have one regulatory agreement that kind of rules everything together. And it's just going to take a little time to implement all of that into where we're going. Now, I'm going to close those slides and go back to the slides that match the book exactly. Now, obviously, you guys understand something about all this. This is something housing authorities had never understood. And why it's important we move them in this direction is that we always set aside the owner entity from the operating entity. And clearly in this regulatory agreement, in the one last year and the one this year, we have worked very hard to do that even more. Public housing, this is the main goal we're really working on anyway, was to separate the project, the well-being of the project, from the well-being of the ownership entity. And to begin to get the ownership entity to focus on the well-being of the project. So we've put that project out there and made it enforceable. RD, by the way, is very much in the same boat. No changes for RD this year. What Stephanie has told me is that she hopes to have the rule out early 15, and then audit. They have adopted, we have a copy of an abbreviated HUD audit guide that we will use for that. And then in particular, there will be it'll be $500,000. Anything over $500,000 you will issue an opinion on, okay, just like we do in HUD, but there will not be any tenant file testing on their RA. So it'll be reserves, mortgage, excess cash, distributions kind of stuff. But the goal of all those things is to make these agreements enforceable between here. So HUD's always managed the fact that the risk was the ownership entity, which this is the same slide as last year. And of course, we're worried about our relationship between the owner and the agent, what kind of services, and it's just simply the idea that comes out of this is here's what you see in this agreement. There are only two audit objectives or business objectives in the agreement you'll see. And they become our audit objectives, by the way. And these two audit objectives are really simple to understand. And it's like this. All the cash that's supposed to be in the project made it to the project. Now that's a big, broad definition that you'll see here in a minute. And then all the cash that left the project was for a reasonable operating expense or an allowed distribution. And when you cut through all this other stuff, that is the end message of the regulatory agreements. It's just working like that. It's to come out and say, look, the problem with the buildings is typically related to non-compliance, and HUD's answer or concern in these cases is that if a building is not successful, it's because it doesn't follow its business agreements. Now that's a pretty we can see that's a patently false assumption, but it's the one they take initially. So we're down to managing these relationships. You sit here at the project becomes precious. I call it the precious because of the way this model works around it. We set up that 35-page regulatory agreement around it. And then we enforce this agreement with a reporting model with REAC on the walls. So we built these walls. We have REAC. We have a moat around it with DEC trying to enforce compliance. And you stand on the drawbridge going, cash coming out. Oh, that's a reasonable operating expense. Good, that can go. That can go. Oh, that's an allowed. Thank you. And all the money that's supposed to be in, I think of you as the chancellor of the exchequer, right? It's just, that's a good thing. That can leave. That can leave. And you're here not to really monitor every transaction, but to look at systems and give an overall opinion that the project's assets were properly, the income came in, the cash came in, and the cash that went out was a reasonable operating expense or an allowed distribution. And when you cut through all the other stuff, those are really the only two audit objectives that you have. Now, you had another one a while ago, fair housing, right? Nobody got discriminated against in a major way. But that was a negative assurance report that has now been removed. So we end up with these two objectives. Has a proof that HUD is trying to protect its interest in the building and make sure it remains adequate collateral for the loan it's insuring. So in a nutshell, that's what HUD really wants to do. Now they've done something special today on this idea of the fourth bullet, entity cash. They've tried to clarify for their own people the concept that we've always had about some cash, despite our aggressive behavior to get the cash, some of this cash doesn't relate to the project. The owner has rights, right? And the owner has the ability to have certain cash and items that sit here in the project but are not technically part of the collateralized or mortgaged property. So we'll look at that a little closer here in the agreement. So at that point, that's kind of how we're going. So, of course, we end up with a hierarchy of a regulatory agreement, a use agreement. People ask me from time to time, Les, I have a HUD insured mortgage, but no Section 8 contract. Do I have to test tenant files? And the question is always answered, I don't know. How the heck would I know? What do your agreements say? And mostly those extra requirements come from a use agreement. Like yesterday, we were in class talking about a decoupled 236 the client had. And he wants to know what his requirements are to maintain that project under 236 once he's paid off the mortgage, but the 5-year compliance period carries on. And I said, you got to get your use agreement. What's in your use agreement? And it'll probably say you have to maintain the housing as low-income housing. And then the auditor knows right away, I have a test to make sure that we complied with low-income housing. So these contracts drive our behavior. And it bothered somebody on Monday. I had a guy tell me, we're not attorneys here to interpret the agreements. And I said, yes, we are. We're not here as attorneys because attorneys only interpret the agreements after we find out we can't agree on what the terms mean, right? So then we litigate. But until then, your assumption of what that agreement says is every bit as valid as somebody else reading it. And that's what you're really here to do, is basically tell HUD the client has materially complied with its compliance requirements. And the HUD Audit Guide forces you to make those changes in how these work. Now, if you would, for the moment, what I'd like to do is take a look at the new agreement. That new agreement is in section 1.1a. So just turn the slides till you get to the first green piece of paper, and we'll be at the agreement. So what you see today is the new agreement has, oh, that's healthcare. Sorry, you got the wrong. I got to get the right one up. That's the 232 one. I can't drive in reverse here. So what I've tried to do is highlight the things that are new in yellow. So that's my highlighter here. Now what we see on the first one, and this is still labeled 92466M. Down in that bottom right corner. Now, here's the thing. You are going to end up now with 3 versions of a regulatory agreement. The old one with 2 columns, the one from last year, 11-12, and now this one. And they all manage things differently. Particularly surplus cash is different in each of them. And then our 232 world, we do things differently again. The first thing we see here is that this regulatory agreement applies to for-profit and non-profit equally. If we're going to restrict the distributions and make residual receipts required, we just click on here and we add a rider for residual receipts. So, like I said, as we go forward, there will only be one regulatory agreement. It will be this one. So both for-profit and non-profit will get them, with the only exception being the few 202 capital advances or the capital advance programs that get done during the year. Now, the agreement itself comes back to the same definitions as last year, which is fine. So we have this big definition of fixtures where they attach everything to the project. I mean, it's, you know, excluding tenant-owned goods. Wiring, machinery, equipment, engines, boilers, incinerators, boy, everything that could go into here. So we're really attaching everything. And I'll skip down here for a few of these. Get down to S, mortgage property. Here we say it means all of the borrower's present and future rights, titles, interest in, and to all of the following, whether now held or later acquired: the land, the improvements, the fixtures, the personalty. And then I have this new paragraph: all current and future rights, air rights, development rights, zoning rights, other similar rights or interest, easements, tenements, rights of way, strips and gores of land. What does anyone, Justin, what's a gore of land? I thought he would know, right? He wears a suit. I have to tease him every day, right? So they've attached everything. Now here's what this means to owners. Even air rights. Any right or benefit that derives from this building being in place means the income related to it goes to the project. For instance, I just had an owner come in and sign a deal for Comcast gave them $200,000 for the rights to put their high-speed cable, internet, whatever, data services into 400 units. And so the CPA goes, hey, what do I do with that? And I said, guess what? It's a right that derived from the building, and the income belongs in the project. Talk about an unhappy owner. No, that's ours. No, it's not yours. Trust me on this. It belongs to the building. Now, if you can keep it there through surplus cash, yay-haw, you can have the money. But until then, the money belongs in the project. And so that's what they've said that goes in here. A GOR, by the way, I had to look it up one day. I'd never heard the term. I thought it was something like, I use the term GOR. I got stuck with a bull. I was running in Pamplona and I didn't make it. So it was like a thing that's stuck in between two pieces of land. It's actually pretty close to that. It's an unincorporated piece of land that exists that you may own. That's in between two incorporated pieces of land. So if your property expanded over that area, that little strip would be a GOR. Isn't that nice to know? I had no idea what that was. Absolutely, yes. Yep. Anything that came to the project by its existence there is project money. So they've been and by the way, I think this is how this applies to other areas would be unknown. I think this is a statement of policy they've already had, but they've put it in this agreement. So before this agreement, we knew cell towers were a problem. That was well known. But we don't know how they can interpret this with all the old agreements. I don't know the answer to that. So I can only say this new agreement is specific to this requirement. Okay? So they've added to that. All the other stuff is listed, I think, is fine. Insurance policies, awards, compensation, contracts, proceeds, all rents and leases, earnings, royalties, instruments, account, all this list, right? All going down here. And then we get to this paragraph under 17. Notwithstanding items 1 through 17 above, the borrower may hold non-project funds in separate segregated accounts, specifically labeled as non-project funds, which are not part of the mortgage property. This has been really interpreted to have been placed in here to help HUD employees understand that there are some things they can't claim. Now, the owner has rights, and one of these rights is, look, you can hold non-project funds. So these accounts hold assets owned or received by the borrower through equity, gifts, or loan that were not required by HUD to become part of the mortgage property and were not made part of the mortgage property by the borrower. And, of course, it includes funds released from the mortgage property, such as surplus cash. And then it said, if such accounts already exist, it is acceptable to identify them here. So HUD wants everyone to know that the owner had the right to keep non-project funds in this entity cash or construction cash. These accounts have existed for the entire time of REAC. And, of course, I think even owners misunderstand that because they're so gun-shy, believing that they've been trained that everything belongs to HUD. So, anyway, that paragraph is new and unique into this particular agreement. So, entity cash is a big deal. In fact, we're going to mention it here 5 or 6 more times in this agreement. So the personalty, all equipment, inventory, general intangibles, furniture, fixtures, you can list all this down here. And then they added this thing, intangibles also include cash and cash escrow funds. I don't know why they actually did that in their legalese. Anyway, they've claimed it all. Now, the other thing that's not new, but I want to stop here and talk about. Program obligations. One of the things that Peter Bell has maintained with this new agreement is that, of course, owners had consistently came back when handbooks were pointed out to them. You didn't comply with this, you didn't comply with that handbook, this handbook, whatever. And they would argue, well, it's not in my regulatory agreement, so I'm not really bound. I didn't sign up for that. Well, now they've included this new language about program obligations, so it said, look, all statutes and regulations are program obligations. All current HUD requirements and handbooks, guides, notices that apply to the project. So they've expanded this language to include all the handbooks and other things, as long as they don't, and it says it right here, and provided that such future updates, changes, and amendments shall be applicable to the project only to the extent that they interpret, clarify, and implement terms in this agreement rather than add or delete provisions. You can't give them new requirements by rule. Okay, unless they are claimed to be interpreting or clarifying terms already in the agreement. So there's some pretty specific legal wrangling going on here in the documents, even though they still end up messing a lot of things up here in a minute. So, AA, reasonable operating expenses. This still gives us grief. It means the reasonable expenses and payments that arise from the purchase of goods or services exclusively used for the operation, maintenance, and routine repair of the project, including all payments, deposits under this agreement, the note, the security instrument, or otherwise permitted by HUD obligations. So, we are very much of the opinion still, backed up by 5 or 6 people I've just talked to recently, including the head of the Hartford office, that they believe HUD fully intends to use these provisions to come back and enforce our residual receipts deposit requirements, to maximize those to offset against HAP contracts sooner or later. And the language is being strengthened in each new agreement. So why focus all that on something if you don't really intend to use it? And the lady at Hartford told me, look, in fact, she told everyone in the room, why do you think we've been telling you to come to us with reasonable uses of your residual receipts? Because we want you to use those now because we believe you're going to lose them. So whatever it takes, we said that last year. It's reinforced again this year. And like I said, if the head of a field office tells you, in fact, she told the clients in the room, we're begging you to come to us and get these things done, because while we still have the authority to approve them, we will approve them because you may not get the same agreement when we move our multifamily operations to the Boston office and we start managing them separately. So very much worried about that. Of course, rents. I think you understand what that means. All rents, residential, non-residential, carrying charges, maintenance fees, other cooperative revenues, income from the land or the improvements, gross receipt, receivables, parking fees, laundry, vending, income and fees and charges for food and other services, whether now due or past due or become due, residual receipts and escrow accounts, however, and whenever funded and wherever held. So that's kind of an interesting thing to tap in there at the back, whether they're in residual receipts or not. Now, by the way, HUD is clearly moving to claim residual receipts. The lady at the field office, her comment was that it's HUD money. I'm going, wait a minute, did you just say it was HUD money? I'm going, so here's the complaint coming out of this. And in fact, the question for accountants is, how much of that residual receipt money do we really leave on our balance sheet has equity? Now, I don't know if you have enough position yet to remove it. But I think that the day is coming very quickly where I think you would have to consider residual receipts not being your money. I don't know that today's the day. But if I were under a residual receipts recapture, it didn't matter anymore because the money's not there. But we did recover all that money. Here's the problem I have. Owners are very upset right now. I got one client in particular where they have a limited dividend entity that they are required to set aside residual receipts in. In the meantime, they're paying taxes on the income from that money. And they can't get the money to pay the taxes because there's no distributions. So they're very angry, and they've tried to renegotiate this deal with HUD. And I said, you will never succeed in renegotiating. They're not going to renegotiate with you at all. The avenue you have to approach is to request the residual receipts for some particular reason. And when I talked to one of the field office people about it, they said, oh, we would probably look at this. In fact, I had when I went back to the residual receipts rider they had indicated that they could have a potential, I have their agreement here, I guess, on how they restructured the limited dividend. They had the right to maybe request some of that money, and they just weren't looking at it. And I think the field office, I think we've now cleared it up and hopefully can get them some of the money released under the terms of their agreement. So they were very unhappy about that. But that's kind of one of those dilemmas is we keep booking residual receipts, paying taxes on it, and I'm not sure we should be maybe anymore claiming that as taxable income because, quite frankly, to the extent we use it, I guess it's fine. But I don't probably have enough ammunition for the IRS yet to claim it's not going to be mine in the long term. That's a problem ongoing for the whole thing. Okay, waste. We had that last year. Don't change the property. Don't let it go down in value. This new non-critical deferred repair funds, this is brought up like 3 times. Borrower shall keep funds of the mortgage property to be used for non-critical repairs separate and apart from operating funds. In other words, it's not project cash. It's construction cash that's dispositioned in accordance with the escrow agreement. And HUD is referring to those escrow agreements like 6 times throughout this deal. They want you to understand that the ultimate resolution or where money goes is determined by those agreements and is negotiated. Sometimes it goes to reserve, sometimes it goes to receipts, sometimes it goes back to the owner, sometimes it goes to project cash. And that's all they're really indicating here is, look, we'll handle those things and tell you what we want you to do or negotiate with you. But once we're done negotiating, we expect you to live in accordance with the agreements. Okay, construction commencement. These 2 paragraphs are really just comments about which way we'll, of course, one is construction or substantial rehab, the other is a refi or a purchase, that they'll complete any non-critical repairs and disposition of the money in accordance with the escrow agreement. So sometimes that money will become part of the project. Sometimes it goes back to the owner. Negotiated items, again, that will be listed here. Permits is fine. You'll get your permits. Accounting requirements. Really talking about cost certification rules, which are not new. The new one, the second one is a little bit interesting, where there might be a cost certification if and as required by program obligation, including all receipts and disbursements, and or the escrow agreement for non-critical, all funds remaining shall be treated in accordance with program obligations and following the escrow agreement. So again, they're mentioning, I think, trying to make it very clear how they want funds handled in each transaction, and they're saying refer to your escrow agreement, right? Which is what we're doing now. Again, the only problem with this is what? You're the only people reading them. Now, it requires you, based on certain disclosure, on items in the statements, to include certain disclosures in the financial statements to prohibit the appearance of equity skimming. which we'll talk about later today. We have put together, based on last December's thing on findings, I've retooled that. I thought that was a good presentation, but I retooled it into something else, and now we've actually made it into a template to handle that. We want to really use that to make some decisions about these things, because we know there are items that HUD looks at here and interprets incorrectly in the submission. So we're using these agreements to help us ferret out each of those particular problems. Now, the reserve for replacement didn't change at all. So we're good with that. No big deal with that one at all. Now, property operation and encumbrances. We have this paragraph, borrower shall deposit money, blah, 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 blah. Now, this is particularly interesting to us, not because of what it says, but what other agreements don't say. And I've trained here for a long time, and I think I've had my own evolution of ideas on this over that 7, 8, 9 year period, or whatever that is. I've been coming here. But this is an interesting one. So, borrower shall deposit all rents and receipts in connection with the financing, including equity and capital required under the commitment or otherwise advanced for the purpose as part of the mortgage property, in a federally insured depository in accordance with obligations, such required equity, blah, 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 blah. Now, here's the thing that's interesting about this particular one. Such required equity or capital shall not include certain syndication proceeds, such as proceeds from low-income housing tax credit transactions used to repay bridge loans, all as more fully set forth in program obligations. So here's the thing. A lot of people have tax credit money flowing in here that doesn't belong to the project. And it was brought out by a client yesterday who had 2 transactions, one handled one way by one firm, one handled by another way. And this was the settlement of this, because she said this is not project money. It's entity cash, or it's construction cash. And so there are certain proceeds out of the tax credit side that in particular don't become part of the mortgage property. So I wasn't thinking about that specifically because it's not highlighted as new, but it did come up again yesterday. She said, look, that tax credit money is my money. It's not project money. So there are certain requirements embedded in here that are beneficial to the client given, whatever transactions may occur. So the other thing is, if I have funds that are project funds, they're only withdrawn in accordance with provisions of the agreement for reasonable operating expenses or for distribution of surplus cash or reimbursement of advances. Well, reimbursement approved by HUD is simply a reasonable operating expense anyway, they'll tell us. So here's your audit objective. The money that left the project was either a reasonable operating expense or it was an allowed distribution. That's what's required under operation. Now, again, why stop on this particular thing? Well, because of this. And this is something I've talked about in the past. This is the 4370.2 handbook. And I probably told, Janet will remember this for sure, but I'm going to repeat myself. This is the 4370.2 handbook. So, it says this handbook applies to multifamily rental projects under a charter or regulatory agreement permitting HUD to exercise control over project administration and operation. Okay, that paragraph we just read gives HUD the right to dictate control over project operation. And then it says it applies to the following projects. Not once will you see a Section 8 contract listed here. So, when we come back to this process of trying to decide what items in the audit guide apply to what, because the audit guide is not clear, right? The audit guide says, here's 1 through 18 requirements. Blah, 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 blah. And people ask me, Les, do I have to test cash receipts and cash disbursements in the HUD audit guide for a major program Section 8? And the answer to that is, what do the agreements require the client to do? Or what rights do the agreements give HUD to dictate? In a regulatory agreement, they give HUD the right to dictate project operations, and therefore those procedures apply. But in a HAP contract, I would say in most of them, they don't give them that right. They only require them to deposit the actual receipts into an insured bank account, and that's it. So they never give HUD the right to dictate operations at that level. And so there is no compliance requirement to maintain. And that's why we stopped to point all this out. The regulatory agreement requires certain things. All these chairs are low and won't go up. And when I have to drive with the mouse, I can't drive standing up. I'm an idiot. Well, I'm an idiot anyway. So, that's what's important about all this. So, he was right. Jim Pollock was right from the deck. He says, we don't look at this as being audit guide centric. We could care less about the audit guide. That's a tool somebody put together to help you audit the regulatory agreements. We ignore that. What we do is we enforce the actual agreement. And if we have a right, we exercise it. If we don't have a right, we don't. And we don't make we make our distinctions based on the agreements. You guys get to be a little, and I don't mean you as a firm, our profession, we get to be a little caught up in the audit guide. And people tell me all the time, like, in fact, this guy Monday, well, Les, the audit guides are manual. It's what tells us what we have to do. I said, no, it's a group of suggested audit procedures, that said this is supposed to happen. But by the way, now it's 6.5 years old, so if a lot of things have changed, my blind obedience to the audit guide causes me to fail in certain audit procedures right now. I mean fail, literally fail. You'll be wrong. So what matters is our foundational principles, and he was really disturbed by my idea that we were to interpret the agreements. And I said, well, how do you know what your compliance areas apply to you if you don't look at your agreement? Well, I rely on the audit guide. And I said, well, how do you know which items in the guide to apply to each audit? Well, it's in the guide. I just do it all, right? And I'm going, please, leave class. There's no conversation for us to have, right? So anyway, they give that whole chapter 11 talks about things like engaging in business activities, incurring liabilities. Now we're going to get to another liability thing, but in any business or activity include the operation of any project or incur any liability or obligation not in connection with the project. So we can incur liabilities. It's just what we're really looking for that to be. Mechanics liens, penalties. Again, penalties have been strengthened by adding civil money penalties to this rig agreement. So I don't know why they felt compelled to actually mention specifically civil money penalties, but they did. Now that brings us down to surplus cash. We don't really have much to say about security deposits, except one comment before I jump into surplus cash. Here are the three requirements. Separate from other funds. It's in an interest-bearing account and in an amount which shall at all times equal or exceed the aggregate of outstanding obligations. So now what I really want to, I just want you to remember that later as we go into this afternoon. So just remember that those three requirements are what's required. Separate account, interest-bearing if required by the state, and it must equal or exceed the liability account. Okay, so surplus cash, redone again. So in this new agreement, and for all this going, I expect this to be the final iteration based on what I've been told that they intend to do here, is this. You must calculate on the last day of the fiscal year, and if permitted, on the last day of the 6th month. Well, I guess we finally decided how to define mid-year for everybody. HUD's just tired of trying to make the argument that mid-year actually meant mid-year. I get 5 or 6 calls in the summer. My client wants to calculate as of July 31st or August 31st because surplus cash is higher than in June. Is there anything against that? Now, they know it's not. They don't feel good about it. Okay, the auditor doesn't feel good about this at all. So they're going, what are the rules against it? And I said, here's what Scott Loveday says. Does anyone know what the definition of mid-year is? Well, apparently we don't. Well, so they argue with the CPA. Well, it doesn't really mean that. You can't point it out to me, blah, 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 blah. Well, HUD now has tried to fix that going forward. In the end, what I end up telling them is, look, if you want to try to fight this battle, you can't win this fight. So you let the client calculate it. I tell them you're wrong, but I can't specifically point to anything other than say the definition of mid-year. I could look at the dictionary. What does the term mid-year mean? Middle of the year? The midpoint, whatever. And so it's a fruitless thing. And I tell them, good luck until HUD catches you, right? So you're aware that I'm giving you notice that I don't think this is right. But now they've settled on it right away. Now, they said surplus cash is equal to the sum of project cash and cash equivalents. And they said excluding the reserve and other HUD required reserves. Now, that meant something particular to Jana immediately because she knows she's got clients, nonprofit clients, who continue to set up extra reserves. Under this new agreement, they wouldn't be able to do that unless HUD had required them. So I have some old 202s that maybe in their program obligations required a painting reserve or something else. I could technically cling to that. But if they refi out of that program and get a new 223F agreement, they'll lose that opportunity. So HUD's moving to try to restrict the nonprofit entities from padding their obligations or their reserves to avoid residual receipts. Now, project cash in this case probably also meant security deposit cash because they don't specifically list it anywhere else. So project cash and cash equivalents excluding the reserve for replacement account and other HUD required reserves. So, now that doesn't mean escrow cash should be there. REAC will not interpret it that way. Okay, REAC has told me they're going to keep interpreting it the way they have in their system. So, excess escrows, on the other hand, is not really listed here, and so nobody's really sure how to manage that. So, short-term investments, 1170, project-based Section 8 receivables. Earned but not yet received, that's 1135, comes in automatically. Amounts approved for withdrawal but not yet withdrawn from the reserve for replacements or other reserves or escrow accounts. Now, in theory here, this is a change. Because it does, the theory I think used to be in the HUD audit guide that HUD had to have approved the reimbursement by year-end to actually include it in surplus cash. This leaves it open-ended. So in my opinion, as long as the money was spent, say, in 14 and approved by HUD for reimbursement any time before I leave the field, I'm going to allow them to include the reimbursement back in the surplus cash calculation. That's a relaxation that a lot of people didn't see before. Okay? So that may open up the door for a little more leeway in certain areas that we didn't necessarily have before. So that is the cash side. Well, after deducting, all sums due or required to be paid within the calendar month, and they're listing them out under the terms of the note, the security instrument, including without limitation, principal, interest, MIP. So the entire first month's payment is withheld now. So now there are three calculations, obviously, one with interest, principal, and reserves, and one with everything from the entire first payment, depending on which agreement you have. Now, the trick in all this is one particular problem. HUD doesn't know which one you have. So you have to tell them which one you have. There will probably be now a requirement. I wouldn't say requirement. It would probably be beneficial if every audit report now listed in a policy note or a surplus cash note how their calculation actually occurs.
Is that also being expected to be on the other current obligations?
Yep. Yep. It will not change right now at all. So it, all in other obligations, detailed out, by the way, line by line, escrow, MIP, principal, whatever, just like you did it last year. He said, go ahead, Justin.
On surplus cash, where there's not a line item at this point to break out where you're going to dispose of, so to buy on other current obligations, I didn't know if they were pay claims to make an actual line item for these things that they're starting to enforce these agreements this year.
And the answer was no. They're going to let you keep. They're going to tell you to keep putting him in other, and then you add a detail for each one. So the first one says principal X, reserve Y, escrow Z, whatever, and you're going to just list it there in the detail of the surplus cash calculation in this other line. How you do that in your own printed version, I guess, would be another discussion. But that's what those calculations turn out to be. So they say, what else is deducted? Well, all special funds of this agreement, the note, the security, or program obligation, including tenant security deposits, other amounts held in trust for tenants, and 30-day payables. So, or payable items payable in 30 days. Now, by the way, the 232 agreements, they don't say this at all. They stay on exactly the old calculation with just interest coming out, even the newest agreement, and they don't have the issue of 30-day payables. But I think their form says it's still 30-day payables. So we don't know how they're going to manage that. It's just some of these. The problem with all this, we should have included security deposits above specifically. We should have, the talking now is about what about excess escrows? And I think the answer to that is, if you want to still do it, you can work it into that model somehow and justify it. So I don't think it is to manage all these calculations separately and take care of those differences. So the key for me is that you're going to have disclosures and include some discussion in there about what these items are going to be, how your item is achieved. But here's the last trick. We have found this to be an increasingly difficult thing to get them to read. We have, and I know this is really stupid, but we have found the only way to get that done is we take this footnote now, and before we submit it, we do a conversion. I don't know how you guys do yours. We take all of our Word documents and we convert them into a flat text file so that when our keyers copy and paste, they just copy, paste, copy, paste, copy, paste. Well, before we do that, we take this footnote and we now convert it to all caps. because it's the one footnote we have to force them to read. And we found the only way to get them to read it was to put it in all caps. So as they scroll through that little band of text, you know, as it prints out, you're going, ah! Yeah, I'm screaming at them. Read me. Read me right now, damn it. So we are screaming our LOL and my BFF, read my, you know, OMG, will you finally read this thing? And that's how we get them to read it. Because, look, I even understand a little bit their dilemma because I don't like to read those footnotes. I look at the beginning and the end. I look at any numbers in between. I can't read the whole dang thing. It's really hard to read. And so I finally decided to quit swimming upstream and just find a way to make them read it. I just yell at them now. So, read me. You could also do this. You could go dash dash. I put sometimes to separate paragraphs. We put 5 underbar characters. You know, the one below the dash, and we separate them out. We go dot dot 5 times, and then we break it. And I could actually just maybe include the text, but only one thing that said in front of the note that in caps says "read me." It's a little tricky game about psychology on how to get them to read the stuff in there. And we've tried a lot of little things because we just are tired of questions. And so people said, do you know how pathetic that sounds? And I said, I don't care. If it makes them go away, it's worth all the pathetic behavior I have. Because what's really pathetic is dealing with them over and over again. And you guys know that. And by the way, we don't key any more submissions. We've actually, we entered into an agreement with a software guy. And he actually has written a program to upload the data directly into React. It's not mine. I don't own it. But we now have a deal where we're uploading that information. We can even upload the notes and all the other stuff too. The only thing he hasn't worked out specifically for us is how to upload multiple findings to know how many findings there are. And he does the cut and paste. And we don't go behind the firewall. The start of our file says we put our login IDs, we have all the information listed, and it actually mimics the keying internally, and we don't key anymore at night.
Is that a per submission fee, or is that?
I think he's going to charge. We're negotiating with him for different things. What he's offered some other people was a per submission fee. So if people were interested, you'd probably have to you think about that. I think the fee right now that we've got to was $100. That can be negotiated probably down slightly. I don't know. It's just for us. We could not. Our problem is we're having to key data late at night, and so to make it work. Of course, it's so slow, right? You key, you hit enter, you wait. We do all of our editing in our so we made the spreadsheet. Our goal was to make the spreadsheet that does all this work, does all the validation initially, so that when it uploads, the only thing you do the next morning is you come in, you have to open the submission, push the validate button, and then make sure any other things, and it should already validate because the spreadsheet validates, but if there were any other tweaks, you then go through the process, finish it, and submit it. But there should be very little left to key. But it keys it all at night when there's no pressure on the system. So if you had an ID that, and I think it takes about 10 to 12 minutes for the submission to go, I can't begin to key anything that fast during the day. So anyway, just kind of one of these interesting things. If you're interested, we can talk. I can give you some information. You can look at it if it's something that interests your firm. Like I said, I'm not trying to sell his thing. I just think it was a cool thing for us. So. So that's going to be the surplus cash calculation, and I think the other side of this really comes down to what's that?
How did we miss that idea? Like, why weren't?
Well, it's not easy to do.
Well, so we said we could get our kids to figure it out.
I don't know. I feel kind of stupid about it too. I don't know why. I don't know. It's just the way things work, right? Somebody had. It actually, he didn't come up with the idea. The idea was mine. He just found a way to implement it because I said, I know there's a technology called a screen scrape, and I knew how technically it was supposed to work, but I'm not a programmer, so I don't write the code. Anyway, it's kind of cool. It makes our keyers during the day. What they'll do now is if the information doesn't come to us in the right format, we'll put it immediately in our spreadsheet. They can key that spreadsheet in 15 minutes, and then of course the spreadsheets just sit at night ready to be uploaded, and they come back in the morning and fix what they, finish what they need to do, and they eliminate all that time. Our problem is we're out there, we can't key during the day. We're tired of working until 3 o'clock in the morning to have our submissions done. We try to have everybody's submission turned around in less than 24 hours. So we were just kind of tired of it. And apparently it's not easy, but he's working on it. We've already processed about 250 submissions in it. So some of those we didn't include the footnotes or other things. We just did the numbers, trying to work through our process for that. But anyway, distributions I think is fine. By the way, this changes slightly in the 232 world. Now, I mentioned earlier about OIG and multifamily and their little dilemma. The biggest single place where that happens is in my nursing home world, because some of these guys generate a ton of cash. So what we did on new agreements is we changed their agreement to allow them to distribute on an estimated basis. So on January we distribute, February, March, April, May, June. We add up all the distributions for those 6 months. We calculate surplus cash, and if the surplus cash is still positive, we didn't take too much out. If it is negative, we allow them 30 days to repay the negative amount, and they're not in violation. Then they just start distributing again. They revise their estimate, and they go. What does that do for them? It removes the regulatory agreement to manage surplus cash in the other way that OIG's mad about. So for this one particular group of clients, on a going forward basis, they will all distribute money based on a budgeted item, not on a already accrued amount of money. And that fixes some portion of their problem with HUD OIG. So for the 232s that you have, if they get new agreements, they have a totally different distribution methodology. So already new ones you would pick up would be completely different distribution methodologies. Which leaves us in a lurch, because now we have 3 calculation methodologies, old with just interest, the midpoint, the current one, and 2 different ways to distribute, which is now in arrears, which is what most of us do, or on a going forward basis, 232s will distribute based on budget. So we're making this kind of complicated on how to manage a portfolio of business. Luckily with the 232s, they mostly have a standalone, that affects the firm but not the management side of the house. Okay, you can't take those distributions. They made one change here which was kind of crazy. Any distribution shall be made or taken within the accounting period immediately following the computation of surplus cash. And then you see the new insert. They said prior to the borrower's next people thought it meant the month last year. So they're running around going, we have to take it in January. No. It was in the accounting period before the next calculation. HUD clarified that, because people go crazy with some of this interpretation of these rules. I don't know why they intend to do that, but they just do. Okay, so I think it's 10:14. Before I jump into this next complete. It's now counting. It's now counting down again. So they've added this whole section on here, and they were pretty stark about it, saying an advance of funds, any advance of funds or loan to the project made for whatever reason. Now, this has been causing a little consternation among people who read this, but it does also say borrower advances do not include equity or capital contributions. So the problem, again, is this distinction between what really is happening with entity cash versus project cash. What are we really doing to advance money versus this or that? The answer for me is generally this. If you need to put money in, I put money in gradually as I go. And so maybe I make a cash call to the partners because we're getting ready to do something. I make that call. They pay $50,000 each. I'm sitting here with $250,000. That money sits in entity cash, and I dribble it in one transaction at a time because when it's over, I don't want to be stuck in this thing about surplus cash because they're going to, they're really holding tight to this borrow advance thing, and you can get interest on it now. But they can only be repaid with HUD approval, which is the old rule. It's the same rule that it's always been. It's just now being expanded into here. Now the question, of course, remains, what is an advance versus what is not an advance? So HUD says, loan any advance of funds or loan to the project made by borrower for whatever reason, or an affiliate. The problem with most of these that the auditors who come back to us with questions have, or that what their question is we're in a centralized cash account. So we're managing cash all in one account. And they're going, how do I know when one of these entities is losing money and how? Because we are sometimes up and down in the accounts over the month. And the answer is, well, by year end, if you're consistently running a project that's negative cash, then sooner or later you're going to be faced with the issue of are we advancing money from the other projects, which would be a big no-no, or are we advancing money from the management company? And there's no one really that set a hard and fast rule on how to do that. So again, your judgment is probably the key component here to deal with. So they added all that language in. They did tell us that a repayment of the advance approved by HUD is a reasonable business expense. Otherwise, it's surplus cash. So that's fine. Now, financial accounting and books maintained by the management agent. This is still the concept of HUD dictating operating procedures in the regulatory agreement, which are not there in the HAP agreement, which is fine. We just need to remember the HAP agreement is totally separate and completely different requirements in general than the regulatory agreement. Okay, annual financial reports. Now, this is really kind of silly because they've added all this major language in here that I don't know that changes a darn thing, but it does give some interesting requirements or some items coming out of this. The first thing was, you see on the second line, borrower shall prepare a report for the fiscal year or the portion thereof that started with the assumption. So they've wrapped these guys into specific stub period reporting in the regulatory agreement. Now, a lot of folks have asked me over time, do I have to file, I'm the seller, do I have to file my stub? Well, look, it all comes down to this. They can't technically, if you're the seller and you're out of HUD, they cannot enforce those rules on you with a civil money penalty or with something else. But what they will do is put a noncompliance flag in apps, and everyone associated with that project will bear that little scarlet letter for forever. I've had that problem here recently. Somebody wanted to buy, it was a new tax credit deal. It was their first deal with HUD with a Section 8. They were very excited to get it done. They hired some consulting people to help shepherd this process through. I'm one of those. Everything is moving fine until we file all the apps and data. Now, you don't usually see that, which is good because it's a disaster. But once one owner at the management company, the two principals, had previously been in a project 20 years ago that had a non-compliance flag, this whole deal stopped to clear a 20-year-old non-compliance flag up. You have to clear that thing up. So, it wasn't really that big of a deal in the end, but it took time It took almost 2 weeks of communications, do the right thing here, talk to the right people. No money was involved, but, that's why they've added all these in here, so that everybody understands you're going to have that problem. Now, HUD made a very particular comment here at the bottom of the first paragraph to follow uniform financial reporting standards. Now, I couldn't figure out exactly why they would add that. And Jana, you'll appreciate this. You know Morge. I was at Morge's firm, and Morge comes to me, and this stuns me to death. He says, we've decided we're not going to include the supplemental anymore in the back. We're going to include the HUD statements in the basic statements. Why? Well, we don't like having 45-page financial statements. We want to consolidate all that crap out and put this stuff in the front and get it down to 30-something pages. Morge, come on, show me what this. He's going, show me. I'm going, come on, I can show you in a heartbeat. Uniform financial reporting standards. So it was kind of funny to me. We've gone full circle of convincing everybody to include the financial data templates, and now some of our people who know dang well what they're doing are going, I don't like it anymore because my clients complain about having 45-page financial statements. And now he's taking them out. And I'm going, ah! But the agreement says follow uniform financial reporting standards. The next thing was, all this, I don't know why this is all here, but it says you'll engage an independent licensed CPA to produce an audit report in accordance both with GAGAS and GAS. Well, that's kind of a curious statement. Why would they write all this in that particular language? And then I found out, I got a call from a good friend. He says, Les, to do a HUD audit, don't I have to have a peer review? Yeah, why are you asking? You know dang good and well you have to have a peer review. Well, he says, I know that, but here's why I asked. He got a call from a controller at the management company who says, we need a new auditor. And the guy says, why? He goes, because this guy isn't peer reviewed. And he's been auditing them for 10 years. Now, the controller's new. So they come out to talk. Well, what they find out is the controller starts getting in trouble with his uppers because they like the dude who's not peer reviewed. He's got a photo of somebody. He's got the evidence somewhere. There's something going on here that we don't quite understand. Well, anyway, the end result of all this, how we finally get the right guy in, is we tell him, you can't hire under these agreements, you can't hire a guy who's unqualified. And this person tells me, you know what his excuse is, by the way? I don't belong to the AICPA, therefore I'm not tied to AICPA requirements. It's only you dumb idiots that stay in the club that have to follow their rules. If you're not part of their club, you don't follow their rules. I said, that's cool, right? You are an idiot. I can understand how but this is not about the AICPA's rules. This is about Yellow Book rules saying you have to be peer reviewed, and you're not. So therefore, all these reports you've issued now are wrong, and you're such an arrogant little putz. I see these guys all the time. There's one every street you go down in my business where we meet with people. I'm too smart for you guys. Yeah, okay, sorry, you're smart. You found a little secret way to get around the rules. Yep, you're a genius. But HUD says you have to be Yellow Book, so that's not a surprise to any of us. I just found that useful that it did show up there. Okay, project management. What's that?
You should have had a finding in there.
He can't even issue. Never mind. You can't issue the reports. Idiot. How did he? I'm not going through peer review. Yeah, whatever. Management. You'll provide management of the property in a manner acceptable to HUD. This whole thing is new, but all it really means is that this information is what must be in the management agreement to comply with HUD rules. And by the way, for your management agent to have already been approved, they already have done this. So as a going forward thing, it's there for that. Contracts. One major change here. Reasonable operating expenses do not include amounts paid for improvements and or betterments unless approved by writing in HUD. Again, the groundwork's being laid again for this issue on residual receipts that sooner or later they can come back and say you have to pay for that item out of reserves. Right? And that's just what they did with MBI. And we expect that within any I don't know when. Yeah, if it happened tomorrow, it wouldn't surprise me. If it takes a year or two to get it done through all these restructurings, fine. But we'll see it come up sooner or later. Tenant organizations. I don't care. Admission and occupancy. Okay, here's where we get the ultimate conversation about tenant file testing in an insured mortgage. Do I have to test tenant files? Well, I don't know. What do I have? Residential requirements. My lease has to be for a period of less than, shall not be rented for a period of less than 30 days or for more than 3 years, blah, 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 blah. No commercial leases can be held. They have to prohibit subleases. Oh, tenant selection and occupancy. If I'm a 231, I have a requirement. If I'm a 221, I have the preference given for displaced persons. So if I come from a federally declared disaster area, I'm displaced, I can move to the front of the wait list. So C is, again, 231. D is 231. So in most cases, the regulatory agreement does not give you any requirement to test tenant files. If you do have one in the use agreement or such, it will be listed now under number 30. Most of those would say what? Low-income housing. And that would be the only thing you would have to test under the regulatory agreement. So tenant file testing has a general concept, does not belong, as the HUD Audit Guide envisions it, does not belong to an insured mortgage, which you were not applying it that way, but I'm just saying it reinforces that process for us. Rent increases, charges for services and facilities, we're fine with all of that. Now, actions requiring prior approval of HUD. The only thing I'm interested in here is conveying, assigning, transferring, pledging, hypothecate, encumber, blah, blah, blah. We already have that requirement in the audit guide. Pay out of number C, pay out of the funds of the mortgage property except as provided in this agreement. So what it really says is this. You have to pay out, the only cash that's eligible to come out of the project is a reasonable operating expense and an approved withdrawal under surplus cash. So they're very clear on how that works. And so we don't really need to go into here. And now, item I, amend the organizational documents. Don't really care about that per se. It's just down into these changes in ownership. The HUD Audit Guide has a procedure for us to deal with unauthorized changes in ownership. People do not necessarily understand what that means. What it means is this. If the owners has originally envisioned in the incorporating documents, if those people were approved in apps by filing a 2530 for each individual, if they have added new people into that list that would have or should have been approved in apps originally, then they need to be approved in apps. Now that can be even limited partners. I've seen lists of people that were approved in deals that were over 60 limited partners long, and they're identified by their Social Security numbers. Now this is something we never see as auditors. So here's the question. I get a list of people. Maybe if I'm going to change the audit guide, I may actually ask them for a list of their owners as they sit in apps. But the problem is that list has their Social Security numbers in it. So then I'm monitoring for changes in that. At the very least, we must inquire if there were new owners that added to the list of ownership, and see, were they actually processed through apps. Now, the firm yesterday had a client there who does that for her organization. And she said most people don't do it because it's a pain in the neck to do, and I can agree with that. That sometimes that app's data can be very difficult to try to access and change. And so I would probably make the judgment call that if they had one or two limited partners that changed, that's a management letter comment. But if they had a significant block of ownership change, then it's a finding, because it's just one of those things that's very hard to manage for the client, and the system is unwieldy, but it's extremely important to release people who leave the partnership, and because now they're no longer associated with, and new people should be added by HUD or by the client in apps, and it's a pain in the neck. So that's kind of how that, people ask me all the time, what does that mean in HUD Audit? How do I change? And I said, look, it really comes down to who should have been approved in apps, which is basically the principals of and owners of the management company, general partner people, limited partners, members, on an LLC, and they literally list them all by their Social Security number in those systems. So, and those systems track them for life. So it's important to make sure, in some cases, that they manage that correctly. Okay, enforcement. Look, here's the thing. Upon a violation, HUD may give written notice pursuant to Section 46 of the violation to the borrower, addressed to the address as stated herein about a declaration of default. 46 would come all the way down, which I would go to here in a minute. We don't need to worry about all the damages. I was just thinking about any other thing here I really wanted to talk about. So, all notices demands a courtesy copy of the notice. It's a 30-day letter. So here's what you get is a 30-day letter. Make sure you stay up to speed on this. Okay. I think that's about it on the regulatory agreement. So, as we move forward, we understand that we get some requirements coming out of that agreement. Now, the key thing, again, is reading to those agreements, understanding what your clients have to do. At the end, interpreting or looking